To systematically identify on your charts price zones that are likely to be retested with high probabilities, and in addition to making either a rebound or a rejection to take advantage of those markets imbalances. That's the whole point of fair value gaps, FVG, or also called imbalance. But what are interest? Remove subjectivity from your trading. No longer hesitate to see a zone or support in such or such place. No longer ask yourself if you have drawn it correctly, and then complete or create a new strategy based on this concept, or even simply better understand market behavior. If you feel like it, let's go. We stay in the smart money domain with fair value gap FVG, or also called imbalance. On the other hand, it should also be known that it is one of the concepts used by ICT, another branch of smart money that we will of course talk about together in future videos. It should be known that fair value gaps have several advantages. It will enable us to pinpoint specific market points anyway, as it's not always very large areas. And then we'll also track certain algorithms on the market, since based on the operation of unfair value cap itself, you'll see there are many algorithms that are built on it. And I can tell you that before the end of this video, you will know how to find, draw and use the unfair value cap on any of your charts. And we start right away with the definition of a fair value gap, FVG or imbalance. So FVG, it means fair value gap. Somewhere in French, it's the fair value of a gap. A gap obviously is a difference between 2 points. What is additionally in English an inefficiency, that is to say a market inefficiency in this specific location. Very important to understand, in fact, it translates an imbalance in the market. Somewhere it's an excess of liquidity between buyers and sellers. We'll have periods where we won't have enough liquidity in the opposite direction, i.e. buyer versus seller or seller versus buyer, and we have this formation of a gap between a 3-candle formation. You'll see it, you'll understand everything in a moment. And so that's why I also put here formation of a gap between the candles. And even in the end, in lower time units, it is the creation of mini gaps that actually reflects this market imbalance. Lack of liquidity in one direction versus the other leads to market inefficiency due to this creation of a market imbalance. Seems complex like this, but you'll see it's easy to find in graphics, but already where to find these gaps. We'll locate them anywhere, anytime, any asset. It's like buff computers. You'll see it's clear and we'll study it on any market. As I was saying here, to identify a fair value gap / unibalance, we need the formation of 3 candles. We'll examine 3 Japanese candlestick candles. We'll focus on the relationship, particularly between the first and last candles of the 3. We will not pay attention to the colors that these candles have. We will study the fact that there is a lack of contact between candle 1 and 3, both on the rise and of course on the fall. So this is very interesting because it worked exactly the same way. We don't look at the color of the candles, we just look if there is a contact or not between candle 1 and candle 3. Between the 2 there is candle 2. It's on this candle that we'll illustrate in a way this imbalance. Time to see how to draw an FPG and imbalance. So I've put here the formation of multiple candles. You find candle number 1 here. So we're going to put it like this instead. It won't be there anymore. You have candle number 1 here, number 2 over there, and number 3 here. I was telling you earlier, we will primarily look at what happens in terms of contact between candle 1 and candle 3. Here we have the lowest point, in fact, of candle 1, and there we find the highest point, the top of candle 3. There is a space between the 2, they do not touch. What does that mean? This means that we have here this imbalance that is generated. We will have this behavior here where there is a lack of touch, of contact between the lowest point of candle 1 and the highest point of candle 3. So here we create an imbalance, a fair value gap, an FVG. It also means that we have so much liquidity in one sense. What needs to be understood is that there were not enough buying liquidity to trigger the sell orders, so the market goes lower, significantly lower, to trigger these sell orders. So this creates this imbalance, this market inefficiency that we call an unibalance or fair value gap, or FVG of course. Now an example on the rise, you always have the formation of these 3 candles, and therefore with these 3 candles we will look at what happens of course between the high and low space of candle 1 and 3. We will examine this renowned candle 1 and 3. We will come to the realization that the highest point between candle 1 and candle 3 does not make contact or touch each other in any way. Here, for example, between this level and that level, we have a space that creates our MVG, our imbalance. If, however, on the other hand, we had this candle that went slightly higher, this candle here, so this wick, of course, of the candle that went higher and lower between 1 and 3, and if we had a contact like that, we would have no imbalance, inefficiency, we wouldn't have FVG. There we have a FVG, and what does it translate? It simply translates that we do not have enough selling liquidity here to trigger buying orders, so buyers who want to enter the market, so the market suddenly pushes higher to find selling liquidity, which allows the counterpart, the taking of orders for purchases simply desired by the actors who want to buy the market at the moment. So it creates a gap here somewhere between these two candles, or on the smaller time frames, of course, lots of small gaps. So this is the formation of a MVG on the rise side. So of course, you're also wondering how we're going to be able to use these FVG. It's very simple. We will be able to use them as entry price levels, that is to say as entry signals, or simply as rebound zones, rejection zones. Always the same, like order blocks, we use them to enter the market or put our market in context and find support and resistance areas, like I was saying at the beginning of the video, systematically. We cannot go wrong in reading these spaces between a candle 1 and 3. So CFVG, we will find them all in the same way on the charts. And that's why it's quite interesting to systematize your approach, whether it's precisely your entry strategy, that is to say the entry signal, or simply a zone in which you will wait for a reaction, a bounce, or a rejection, depending on the direction of the market. I recommend you see platform examples immediately. Here we are on TradingView. We'll analyze the euro-dollar on H4 and the formation of gap. We'll enlarge the graph a bit here to make it clear. We'll start again from this downward movement on the euro-dollar pair. So I merely study, truly observe, and closely analyze what occurs between the formations of 3 candles. Candle 1, candle 2, candle 3. Hollow here, you see, doesn't touch when I connect with magnet, simply doesn't touch top of candle 3. I just shift slightly to this side, and that is what occurs. You observe that over there, we possess a touchdown here and there directly in the zone. So here we have a reaction to a fair value gap, an imbalance in a downward movement, market inefficiency that needs to be worked on to allow triggers of the same order. So there, as I was saying earlier, for example, in this decline, we go back to what we were saying earlier, which is that we don't have enough buying liquidity here to find the counterpart of the sell orders that the market is currently receiving, and as a result we continue to go down, and it triggers this FVG formation here, and we will tend to return to the zone. Why? Simply to either close orders or of course to be able to resume, according to market participants, resume orders that were unable to be executed in their entirety due to triggering constraints. Since we didn't have enough liquidity to sell the market at that price, we went for lower prices. We want to return to the zone to resume higher prices, or in the zone to continue the decline better. Concept, fair value gap example, H4 on euro-dollar. Not the only one, we will be able to go down. You will see that there are fair value gaps that are not always immediately filled, but like gaps in the markets, we like to see gap fillings. Here, we'll see that, for example, if we push, hop, here, you see I spread it out as much as possible. It ends up reworked, goes down a bit, broken again by water, but you see it's been reworked. So in fact, all these fair value gaps, all these deemed balance eventually end up like the gaps in the markets, the classic gaps, simply being filled here too. We have another training here on the decline as well. I dismiss it. You see, we come to touch, we even go a little bit above, so it goes down. When discussing these areas, we won't include this one since it's not immediately affected. What interests us are these points and also these points. So working here allows for orders and positioning, as mentioned before. When studying fair value gaps, it is also to find buying opportunities, selling opportunities. So there are typically, if we have a buy order on these fair value gaps here, several techniques, always the same. I'll talk to you a little bit about stop and TP. Per strategies, we position just above the area. While being careful, we fetch the pile from the last low point. Here we have a magnificent ratio visible on this opportunity. We'll zoom in, giving us 9.75. We can exercise a bit more caution and opt for a slight margin above the last candles, or alternatively, the previous peak. You see, it's already a 1:1:3 ratio. If we go, for example, here from 257, this is fully customizable. If we stay like this, with just a sensitivity above the zone, most of the time, we'll have more advantageous ratios. You just need to be able to test all this to make sure you don't deviate too much from the position. For example, here you see, if we didn't have any at all, so I'm going to put the order here, and I'm going to remove that. You'll see here at the entrance of the area, for example, if we didn't have any safety margin at all, we would simply have ended up in loss. That's why you must be cautious and considerate of sensitivity when setting your stop loss. It's an additional tip that can assist you regardless of your strategy or trading style. It's consistently valuable. There, otherwise we have 719. Likewise, if we look above the previous candles, 2.73 or else 1.4, but these are still interesting things. So there, for once, I'll leave you a little bit above, and we will see the rest, of course, always formation of 3 candles. For example, we look at the market here. There is the formation of 3 candles between necessarily the low here of a first candle, the top of the third candle with candle 2 in the middle. Spreading here, still have a nice test of the area. Same here, remove the element for just 2 seconds and show you the example on the entry point of the area. The location function here works, regardless of whether we are just above the area, a little above, etc. It also passes for a test of the last dip, e.g. with a nice ratio of 3.51. That's examples on H4 Euro-Dollar chart. Down. We'll see what's happening on the other side in terms of growth. What will we find? For example, just this one thing. Here you'll see we have this one, we have this one. You need to know that sometimes you have different areas. We're going to zoom in a little bit. You will have different areas and all your fair value gaps will not be immediately affected, filled. And so you see that there, we have 1, we have 2. It's number 2 that will be tested earlier. And same here for a small example of purchase. If I put it like this on the input area, either just behind the area or slightly with a margin, let's say, just behind the second one, etc. For last summit test, we already have 1.63, so increase on this test from upward fair value gap. So there, I remind you of the concept. The concept is that we have not had enough here. So in these spaces, of course, market inefficiencies and inefficiencies. We did not have enough selling liquidity. As a result, the market pushed higher to trigger buying orders from buyers in the market. And so it generates interest in these areas to come and be filled, since obviously in addition inside here on the small time units, it creates gaps, but otherwise it also generates the desire to come back to it for some to trigger new orders to rise while others will close their orders. So it depends on each participant at time T, of course, but it is in this concept that you see that it plays the role of resistance, the role of support somewhere, but systematically, since we will not be able to be wrong by saying, yes, I take the wick, I take the body, I need 4 or 5 tests. Here, you see 3 candles formation, the low point, the high point, for an example of a decrease here, the high point, the low point, in between, of course, always respectively, candles 1 and 3 for the buyer's side. Then we leave the area, observe the outcome. So always the same, like the principle of support and resistance, we can't always be retested right after. For instance, if you gain, or if you're more inclined to think, well, I'm more conservative, I'll need to wait for this retest, sometimes you won't have it. Sometimes you'll have it, it'll save you from being a loser. In this case, the market stopped at the first and continued as a result. Last little example here on the USDJPY to show you a little something else on our pair as well. Here we have the formation between this candle and that candle. That's why I wanted to show you this, because you see, we don't focus on the color of the candles. We have candle 1, a red one. We have candle 3, a blue one. The middle candle is also blue. So we have here the creation of a minimum viable product, an imbalance in a market characterized by an upward trend. And so we will rather wait for the retest of the area here like that in this way. And that, of course, is the most conservative version, for instance. It can be to look at the latest lows for the stop, or just behind the area with a little sensitivity. The ratio changes a lot compared to that, and we have a good example too. But that is truly every time examples, as you could see. And I want to return for a moment on the euro-dollar, where I demonstrated you every time what occurs on pending order if this fair value gap is directly the entry signal for you. Otherwise, we can also look at what is happening in terms of reaction, and there we can take a little look and compare what can happen. Since we have this scenario, which is the triggering of the zone, we will stop there and we will do it like this. And if we had looked for confirmation, maybe in terms of candles, what can we have here? For example, we can have this small rejection candle that will just reach the last peak on the other side there, and we can say to ourselves, I prefer to enter in the other direction on a confirmation of a Japanese candlestick formation that may allow me even more, perhaps somewhere, to tell myself that the stop loss behind is not too bad. And there you see we have 3.76 versus 3.51, so it also depends, of course, on how we want to do things. And here is an example both for input signals directly on the markets and simply a zone waiting for confirmation and price behavior to see if the zone in question marks rejection or rebound. Of course, rejection for a decrease, rebound for an increase. I hope you like these new videos. Feel free to like, share to let me know this content interests you and pleases you. I invite you in the meantime to already watch the different videos of this playlist and especially very interesting tutorials.